Morning traders and welcome to New Trading Week Ahead. I guess one of the questions we've been fielding is with the extreme easing of financial conditions through November, one of the biggest monthly rallies we've seen in equities for some years, and with the S&P, the Nasdaq and US 30 all within touching distance from all-time highs, where is the balance of risk now in the short term? Obviously, we don't know the future, but we can think about this in a distribution of outcomes and in a probabilistic sense and weigh up the balance for a case for higher levels and also the case for covering longs and sort of weighing up into that situation. So I think if we look at the case for high levels in US equity markets, I think first of all, the market knows that there's a significant amount of money that's coming into the market on the 1st of January. People are front running that situation, those very positive flows which are coming in. If we look at the technicals at the moment, well, clearly the fact that the markets are going up and, we close on the highs suggests that there's great demand for equities at these points. People have talked about the Dow having an RSI above 80. Well, if actually you look at and backtest this over the last 20 or 30 years, there has been a reasonable number of occurrences when this has taken place. But generally speaking, about 70% of the time when we do see it cross above 80, 5 or 10 days later, the market is higher from that point. So it's a testament to strength. And generally speaking, you get higher levels playing through. Now, of course, the Dow is a whisker away from all-time highs. I think with the S&P, we do need to take out the swing high that we got on the 24th of July. And I think if we get a break of that level, then obviously, we'll be very much gunning for those higher levels coming through. But certainly the technicals are looking pretty strong at the moment. If we have a look at the quality of the rally in the S&P, it's been very, very positive indeed. It's not just been a handful of concentrated stocks, mega cap stocks, the Magnificent Seven, which has taken us higher. High beta stocks have been smashing low volatility beneficiaries. Cyclical stocks have outperforming defensive areas of the market and defensive stocks. Advanced decliners working well. You've seen the Russell outperforming the S&P, so small caps have been working quite well. If you go into market internals at the moment, you can see that 20 stocks above their 20, 50, 200-day moving averages have been moving up quite nicely. That shows, again, just really good market participation in this rally we've been seeing. You can see that 57% of stocks are now trading at 4-week highs. 32% have got an RSI above 70 at the moment, which is the highest level since 2020. So, market internals have showed really positive participation, but we're not showing extreme levels at the moment, showing extreme greed, and therefore, high conviction about contrarianism playing through. S&P short interest is 1.8% of market cap, which is actually one of the highest levels for some time, even though short stocks or short interest stocks have rallied significantly. So shorts have been burnt, but still there's a huge amount of short interest in the market, which still needs to come out. And actually, if you have a look at 10-day realized volatility in the S&P or 20-day realized volatility in the S&P, it's coming down very, very sharply at the moment. 10 days realized vol is currently trading around 5.5%. So it's really hard to see the VIX moving sharply up and people looking to de-risk in that situation unless realized volatility starts moving up as well. Now, the case to cover longs is obviously pretty compelling. We've just seen that huge easing of financial conditions, and people are saying, well, does that give us a probability that we're going to see tougher times? Maybe not, but certainly the distribution have shifted a little bit. And we've seen the fact that the S&P is up for 5 weeks in a row. Now, since 2007, I think we've seen 12 occurrences where the market's been up 6 weeks in a row. So it's pretty rare. And I think the last time we saw the index having 6 weeks in a row of gains was in 2019. That doesn't suggest we're not going to get it, but obviously that does change the consideration there. If we have a look at rates market, and I think this is really, really important, we've seen a big adjustment in rate expectations. And if we have a look at swaps pricing for 2024, we can see that there's effectively 131 basis points of cuts being priced in by December next year. That's a 5.5 or just over 5 rate cuts playing through, which some people may see as fully priced or fairly extreme at these levels. We've also seen a 70% chance of a rate cut by March. Now, what it does tell me is if we do see some of the data coming in this week in the US slightly better, we could see the dollar having a bit of a rally. It could be very sensitive to that. Rates could see some covering, and that equities may not like that situation. So obviously we're looking at the JOLTS report, we're looking at ADP, we're obviously looking at non-farm payrolls numbers on Friday. And if we get a big beat on that situation, unemployment rate coming down and average hourly earnings moving up, then obviously we could see some of that rate pricing coming out and equities may struggle. So that's obviously something that we do consider this week. And we have seen a material adjustment in real rates. I mean, we saw back in October, 5-year real rates were trading at 2.70%. They're currently trading shy of 2% at the moment. So that's been a big adjustment to the downside. The market's saying, the US economy likely to slow. quite significantly this year or the next year. We don't need real rates at 2.7%, and they should be close towards 1.5%. But obviously, equity markets have loved that move in real rates. So the question is there more juice in that? Certainly some of the money, the easy money has been made there. Everyone is short vol at the moment. You've seen that in the VIX, but you can see that in the optionality markets where 25 delta puts are trading at a mere 1.18 vols premium to 25 delta calls. So certainly that skew has come right in, and we've seen that on a normalised basis as well. And certainly some of those tail hedges have really been rolled off. If we're looking at 10-day delta puts at the moment, they've come right down. So obviously people have removed those hedges. Hedges cost money in a market that's going up, so people have moved that down. That doesn't necessarily mean that we're going to see the equity market under pressure, but obviously people have removed a lot of that defence that they've seen in case of drawdown. You've seen that in the put-call ratio at the moment, which is trading at 0.51 times, one of the lowest levels for some time as well. So again, just market taking down protection. And valuation is pretty punchy at 21.4 times forward earnings. Now, I think the market's sort of refrained from looking at valuation for some time. It's really been about flows. But that may well matter going into the new year. So obviously, when we're looking at these factors, we're looking at the technicals, we're looking at the case for high levels and also to cover longs. I certainly think they're a lot more evenly balanced. My best guess is that we'll see maybe a bit of downside, but I think people will buy that for another rally into year end. So I do take the view at the moment, given these factors, that there's higher risks of higher levels of equity markets into year end from here.